It's Shannon Smith from Smart Business Solutions Financial Planning. Wanted to talk to you today about investing in property. I know a lot of my clients, and I think that really comes down to a lot of Australians, we do have a love for property in our country, despite what's going on now with a bit of a slowdown, but we do have a love for property in Australia. A lot of us Australians have always loved property. And I guess we've kind of seen it as potentially less risky than other forms of investment. And I think that's just something that has come about as a community or as a nation. But one thing what I want to talk to you about property is it's really important to have a look and make sure it is actually going to be right for you. So some of the things I want to go through in this slide is, property deciding, what are some of the things you need to decide when you're looking at investing in property, looking at doing your research and what is that research. I want to explain to you the difference between capital growth and rental return. And also I'll touch a bit on investment mortgage and then minimizing your risk. So some of the things that I do see is people jump into buying a property that is next door or something like that. And there is and the number of times I've had clients come in that have been, they've ended up buying the wrong property. They've got emotionally attached to the property and they haven't really looked at the numbers. And I mean, as an accountant, I love the numbers. The numbers need to work. So I just want to raise for you and go through. And it is different to buying property than buying your family home that you're going to be living in. So I'll just go through some various different aspects that I want you to have a think about if you're looking at investing in property. So before deciding to invest in property, it can be a great way to build up wealth. I personally love it, but it really does carry a certain degree of risk. A lot of people think, oh, look, I buy a property and in 10 years, it'll double my money. But there's no guarantee on that, And one thing about property, it may be less riskier than compared to, say, other assets you have, so potentially shares. You still need to evaluate whether it's the right level of risk depending on the investment for you, because some of the benefits of property, generally speaking, less volatility. So property can be less volatile than, say, shares or other investments. You will earn a rental income if the property is tenanted. Potential capital growth. If it increases in value, you'll have that benefit. Tax deductions, you can claim a lot of the property expenses off against the rental income. You do have a physical asset that you can go and basically stand on that piece of land that you own. And there's also no real specialized knowledge needed. Now, some of the cons and some things to think about when investing in property is the cost that potentially the rental income may not cover your mortgage payments and other expenses. So how are you going to fund the difference from a cash flow perspective? Interest rates, a rise in interest rates is going to increase your repayments required and lower your disposable income. Vacancy, there really could be times when it's vacant, and what do you do then to cover your costs? It may be inflexible from the perspective of you can't sell off a bedroom if you need to access some quick cash. And there always is potential for a loss in value. A lot of people think that property does just keep going up, but it really can lose value as well. And then there are high entry and exit costs, stamp duty, legal and real estate agent fees. So there's some of the things to decide before you actually go into looking at investing in property. Then I guess you need to think about your investment strategy, because that's really going to, dictate how you are going to go across what type of properties. So as part of your financial planning process, we will discuss with you short-term goals, long-term goals, and really create an investment strategy for you. And that there may be, depending on the investments you wanted to do, but with some of the investment on from a property perspective, the most common investment strategies around property would be you're going to buy it and hold it, and you're going to purchase it for the long time, wait for it to rise, sell it, earn income off the rent, which, and until the property's sold, but basically buy and hold it for a very long time. You then have your investment strategy could be renovating, purchase the property, renovate it, add some value, and then sell it for a profit. And then the third most common one is capital growth. So you try to get zero in on a property and location and current market. that will quickly grow in value. So you may stick to an interest-only investment loan to reduce the non-deductible tax costs and then sell the property after just a few years. So you've got to think about what's your strategy, and is then the property you're looking at going to be consistent with that strategy. So capital growth and rental return. So regardless of your strategy, you need to buy a property with some capital growth potential, or one that you can and one that you can rent out. I mean, in short, you need to do the numbers, and that's where we can help, but you definitely need to do your numbers to see if the investment actually makes financial sense. You also need to make sure the return your property generates is comparable to the return you would have made if you invested in another asset class like shares. Now, I have a saying that people have said, it's a famous saying now, but negative gearing without capital growth is just social housing. And the reason I say that is I've had many times clients have come to me after buying some property through some, slick property agent, so to speak. They've bought the property. It's got a great yield on it, and they're saying, great, I'm getting negative gearing. Yet, I've got a number of clients that bought properties, 5-6 years ago, and the value hasn't gone up at all. So negative gearing, which is when you're making a real loss that you do get to offset it against your other income and get a tax benefit, but you've actually made a real loss. So negative gearing without capital growth, and you're only doing that because you're hoping for the capital growth. So if you don't have capital growth, then really it is just a form of social housing, is what I like to say. So then when we're looking at capital growth, what do we mean by that? So capital growth represents the increase in the property's value over a period in time, and is why most people do invest in property. The property market basically functions in cycles, with a period of growth, then it kind of plateaus a bit, maybe declines a bit, and then up we go again. So considering that, it's really clear that investing in property should be done for the long term rather than expecting a quick return. Then you've got rental returns. So you need to study, if you're looking at buying a property, study the average rental price for similar properties in the area, and ask yourself whether you would receive enough rent to cover all the maintenance and still allow you to make a profit. Because often if you buy the house next door, so to speak, sometimes you may not be actually getting the yield that would actually enable you to be able to fund it and looking at it. But again, it comes back to your strategies that you're looking at doing. So the yield is an important figure, which is what you calculate by dividing the rent that you'll receive over the year by the price you paid for the property, and then multiplied by 100 to get to a percentage. But that's your rental yield to see what yield, what return are you going to be getting on your investment. So finding the right property, that's probably the most important step of all. You need to find a property that matches your investment strategy, appeals to renters, and will retain value over time. You'll need to make sure you're paying a fair price for the property, and check that the property is structurally sound, and make decisions on the following. Consider property type. So do you want to do commercial or residential? Now, actually, I'll talk a bit about, I guess, both in this presentation, but I do have a separate presentation on commercial property as well. So if commercial, what type? Factory, retail, medical? And if it's residential, do you want a unit, freestanding house, townhouse? Then you've got to decide, do you want new or established? Now, some investors prefer to buy new buildings, while others see more value in established buildings, and it can vary the depreciation. You also need to think about the suburb and the location. That's going to have a big impact on your investments. So to be sure to look at the suburb level data and look at the streets and go around yourself. So what are some of the differences between, how does investing in a commercial property differ from, say, a residential? So it's really important to understand that investing in commercial real estate does differ significantly from investing in residential. So while you still rent out the property and you receive a rental income from the tenant as you would with residential investing, there are some really core differences between the two. Commercial lease agreements are generally for longer periods than residential. You'll often have a director's guarantee or something on the lease as well. Vacancies between different tenants tend to be longer for commercial property. So once you've got a tenant, you've got them in there for a long time, and you've got a lot of, assurance, because you'll have a director's guarantee, that type of situation. But if the tenant leaves at the end of the lease, it may be empty for a good year or so. Whereas residential, you drop it by $10 and another tenant comes in. Unlike residential property investing, the GST applies to the purchase of a commercial property, and income and expenses with the commercial property may mean that you will actually have to pay GST on those as well. When you do buy it, if it is vacant, you will have an extra 10%, so you'll need to allow for that in your funding. But the good news is you do get the tax back. But it is something to consider. And maintenance expenses, for example, with commercial property, it's normally covered by the tenant. The tenant pays for all the outgoings, whereas a residential property, it tends to be that the landlord needs to pay for all of those. So then if I look at then the difference between new and established property. So the pros of buying a brand new investment property, I guess, would be the depreciation. So the newer the property, the higher rate of depreciation for you, which is great for a tax deduction. Tenant appeal, generally new dwellings are maybe perceived as higher quality, look better. Protection, it is covered by the builder's warranty. So you're going to have a 7-year home warranty kind of a protection on it if there's any major building defect. Generally speaking, low maintenance and security. Most items of a new property are covered by the builder's warranty, which means you might reduce your ongoing costs. Government incentives, sometimes there's stamp duty concessions, grants, and a few other things that are there. New is not always better. A few cons to think about. It's often, depending on the particular house or product, it can be less affordable. There may be limited value adding potential because you've just paid the full market price for a brand new house that you cannot improve anymore. And then there's also a greater market risk when it is new and it's not as known commodity as I like to often think of. So what are some of the differences between new and established, continuing on and looking at it from an older property? So some of the benefits of an older property: renovation potential, affordability, potentially property history, negotiating power, capital growth. But there may be some risks like maintenance. You may be buying a money tree or a money pit where you're going to have to keep putting money in. Maybe lower rental return, less appeal, lower depreciation deductions, very low depreciation deductions as a result of the ATO changing the depreciation, which is why from a negative gearing perspective, we often see people will invest in the newer properties from that perspective. So now, costs of investing in property, make sure you consider some of the costs that you're going to incur, such as the cost of buying and selling will be stamp duty, conveyancing, legal costs, search fees, pest and building reports. If you sell, you'll also have the agent fees, advertising costs and legal. So you want to make sure that the property's increased enough, and that's where it's looking back to your original strategy. Then borrowing money to buy. If you borrow to invest, you'll have to pay, obviously, the property mortgage. Don't just rely on the rental income to cover the mortgage, as there may be times when the property's empty. So I'd always recommend, having a bit of a buffer and keeping that just to keep yourself not to have a panic situation. So some ways of really, I guess, minimizing your risk when you're going into this type of investment is really to actively take some proactive steps in diversifying your property portfolio and have a look at things like having that cash buffer, as I said. You may even want to look at a split and fixed interest rate. So half of it's split, half of it's fixed, half variable. You might split it. Yeah, so have a split loan or you might have a fixed loan. Invest in different areas. Don't buy, 3 houses in the same street. Do your market research and use an expert if you need a property expert with the new properties. We have got one that we can refer you to that could help you out with some of those. But just go and use an expert. It's not always your real estate agent down the road. It may be, but just try and find someone, and you need to get the numbers, and we can help you and link you up with some people to help. But it comes back, I guess, to your investment strategy, what you're trying to look at. So some of the tax tips in related to property investment: look at your deductions. Keep all of your information on deductions, council rates, water rates, agent fees, costs. You can actually prepay the interest. So did you know that you can actually, interest is deductible when you physically pay it? So if you've got the cash flow there, you could prepay your interest in June for the next following year. You need to make sure you advise your bank that you're doing that so that they don't just take it off the principal of the loan. but you can prepay your interest for 12 months, and we can claim a deduction. So if you've sold a property and you've got capital gains in a year and you've got another investment property, we might get you to take some of the cash from your capital gains and prepay your other investment properties interest for a year to help reduce your capital gain, if that makes sense. Non-cash deductions are your capital works and capital allowances. So you'll need to get an expert depreciation report for those. And then capital gains tax. So the cost of the asset or the property is the cost base for the capital gain. So it's really important to keep a lot of that information of when you've purchased the property, and so that you've got that for when you potentially sell it down the track. Anyway, if you've got any questions, if you need any help to do some financial modelling on a property that you're looking at, feel free to reach out and contact us, and we can crunch through the numbers for you and make sure that really the property from an investment perspective is going to stack up to what you're looking at doing. Thanks very much, everyone.